The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, for the most part, it felt like the markets coasted their way into the holiday weekend on Friday's trade. We were mixed to lower in the grains and oil seeds, mixed in the livestock trade, trying to find a little bit of strength in cattle, but overall, a fairly quiet day outside of a few headlines in the news early on Friday from President Trump that maybe put a little bit of a damper on the markets ahead of the holiday weekend. Let's talk through things. Joining us for analysis and a conversation, Ted Seifert with Zaner Ag Hedge. Ted, it's good to talk with you again, my friend. Hope all is well. And I'd say Friday, an end to what was a fairly decent week in the markets, but kind of just kind of a quiet end to the week overall, I would say, Ted.
Yeah, it was a pretty decent week. Friday wasn't great. It was not a great way to end the week, but a little bit of profit taking in front of a 3-day holiday weekend. I don't know how much stock to put into Friday, but I will say, Thursday into Friday, we were running into some key technical resistance levels for corn and wheat in particular, also for soybeans, and then we pulled back fairly significantly off of those resistance levels. So the question that we're going to go into this 3-day holiday weekend with is, was this a technical bounce off of a yearly low in corn, a contract low in wheat, and a really tough level of support for soybeans in the form of both the 50-day and the 100-day moving averages? So was this all technical? And now that we've fulfilled those upside technical objectives, are we going to turn around and go lower? Or is this, hey, we ran into resistance, we pulled back, but now we're gearing up to break through that. So early next week, again, starting with Tuesday because of the holiday, that's really going to get tested. And so that's what we're going to be wondering. We have the seasonality, which should be positive pretty much across the board right now. We've gotten planted fairly quickly. We still have some trouble spots that we're worried about that continue to get rain. They've kind of mudded some things in, so I think they'll get it done, but obviously there's still some areas of concern, and then there is that concern for the longer term forecast as well. And that would play into that normal seasonality, right? But then we also have the bigger, broader picture things that I don't know. We just had a week where I think we kind of got lulled into thinking, hey, maybe this storm is sort of past us for now, right? And maybe it's just going to be business as usual for a while, and we won't have to hang on the daily headlines of tariffs or no tariffs, things like that. But then Friday comes along, and Trump's talking about a 50% tariff on the EU, which is a big trading partner of ours for agriculture. So like, oh man, and that was part of the reason for the sell off on Friday, or profit taking, if you will. But if we're going to get back into that cycle, into that news cycle, well, it really makes seasonality kind of seem like an afterthought. Like this could be the year that seasonality is not the focus of the market, or something that really works for the market, because we have bigger actions, bigger things at play. So there's a lot of things to be pondering and thinking about as we go into the 3-day holiday weekend and have, good time with friends and family, and, cold adult beverages and whatnot. Because I think next week is going to be a pretty big deciding moment for a lot of these markets. And generally speaking, these 3-day holiday weekends, approaching or getting into the growing season. I mean, you think about 4th of July, you think about, you think about Labor Day. Those 3-day holiday weekends are pivotal turning points really for these markets, so I really do think next week's going to kind of prove some things out, and give us a better idea of what the at least the midterm trend or path is going to be.
When you look at these grain markets, corn, soybeans, or the wheat complex, and you look at the technical picture or the weather thoughts, the seasonality thoughts, etc., is there one of these complexes over the others that maybe has a little more of a bullish feel to it as we work through this holiday weekend and think about heading towards Father's Day, 4th of July, et cetera? Is there one of these complexes in general that you are maybe waiting to see if we can find some bullish momentum here after the weekend?
Yeah, I mean, look, it's gonna make me sound stupid because it always does. But man, I want to say the wheat. And look, the reason for it is because one, I think we've gotten undervalued for the wheat. I also think that if there is a conclusion, or at least a ceasefire between Russia and Ukraine, that Russia might stop being so aggressive on the world market selling wheat and maybe more picky about pricing. But also, I just feel like we factored so much bearishness into the wheat, right? The USDA's new crop balance sheet for wheat is almost a billion bushel carryover. But in the meantime, we've got some really good export sales, Jesse. I mean, we're at we're off to like a 12-year high for the start for the next marketing year, which starts really soon for wheat. I think there are some good things happening there, even though conditions have improved. The wheat tour found some pretty good results. But like I said, I think a lot of the bearishness has been factored into wheat. Now, that being said, the technicals for wheat have been so bearish for so long. It's going to take a lot to really get that spark to occur in wheat. But I think that is a market that is really primed for it. Whether it's now or further on down the line, I don't know. And some of that might might be correlated to corn. And then corn would be my second pick for upside potential. Obviously, we had a lot of pressure on corn up until this week. We've had a nice bounce off that low that we put in last Tuesday. Um, but you look at the long-term forecasts and you do get concerned about corn. And for the idea that like, hey, we're planting very quickly, so we might see more corn acres. I don't know. I just inputs are so expensive and kind of scarce. And for the lack of fall field work, I really think if there is a benefit, or if there's somewhere to gain acres, which in years where we plant quickly, like this year, we usually do gain acres. I think it's going to be more soybeans. Um, so I don't know if you're going to see that corn acreage number go up dramatically from what we saw in intentions. And given the longer term weather outlook, the concern that we have, I would think at some point we should start building a little bit more weather premium in. Now, what I don't know is what happens with that July December spread, the old crop new crop spread, because something's really kind of gone awry with that. We went from almost a 45-cent inverse down to a 2-cent carry, and then back to about an 8 cent inverse. So there's a slight inverse at this point, but very little. And if you look at the USDA's old crop balance sheet, which we're the end of this marketing year is the end of August, so we're kind of headed into the finish line. And you say 1.4 billion bushel carryover, that's a good billion bushels less than what we had been talking about at first glance last year. That's a pretty tight scenario nowadays. I mean, pipeline, back in the day, it used to be 900 million bushels. Now it's probably like 1.2, 1.3. So it's I'm not going to say excessively tight, but it's certainly a lot tighter scenario for old crop corn than what we had initially thought. Export sales continue to be strong and really good. And there's argument that the USDA is going to have to raise that export number again, and that balance sheet's going to be even tighter. But you're not seeing that reflected in those spreads. You're not seeing that reflected in the cash market. So it really gives you the feeling that there's more bushels for corn out there, that we might get surprised by something by the time we get to that September 1st quarterly grain stocks, which is, for all intents and purposes, that's our ending stock number, old crop ending stock number. Was last year's production bigger than what the USDA said? Did they cut the yield at the end of the growing season last year because of the hot and dry? Did they cut it too far? Or is that feed and residual category really overstated? That's one that I've been looking at. So I'm not sure about what happens with that spread or with July corn, but I think the December contract, the new crop contract, should see some weather premium. Now, it would obviously be less weather premium if there is, in fact, more old crop bushels out there. That's a bigger beginning stock number, a bigger cushion. Also, if there is more corn acres, well, that's less of a reason to have to build in that weather premium. But given the forecast, especially for the western half of the corn belt, I would think that corn at some point should try to build in that weather premium, as long as we don't get derailed by bigger, broader picture things, tariffs and what that could mean for the global economy, domestic economy, all of that. I mean, it is there's this dark kind of cloud or potential dark cloud that's hanging over us, that's I don't think is going to leave us alone anytime real soon, Jesse. So I think you have to take all of the typical grain market analysis and thoughts and seasonality with a little bit of a grain of salt this year and realize that it might not work the way it usually does. I mean, we don't put our highs in corn in February in normal years, but again, you have to ask yourself, is this a normal year? And I don't think we have that answer for sure yet, but there's reasons to be worried that it might not be.
Ted Seifert with Zaner Ag Hedge joining us here for market analysis today on Market Talk. Since you brought up the economy, I do want to ask you about that, Ted. I know we had the Moody's downgrade of the sovereign debt of the U.S. here recently, and this whole outside market economic picture. A lot of folks have been talking about this and been wondering about some of the grain and livestock implications here. I know our friend Joe Vaklovic, he had a video out a few days ago, the Sell America trade. I
Yeah.
thought his stuff there was interesting. Joe does a great job. I guess your perspective on everything that's going on with these outside markets and the talk of inflation and stagflation, et cetera, probably setting you up for a soapbox moment here, Ted. I mean, what's your thoughts on all of this as we head through the holiday weekend and how it's played a role in the ag trade right now?
Well, first of all, I haven't seen Joe's thing. I should check that out maybe if I get a chance over the weekend. To your point, he does great work. But you mentioned sovereign debt being downgraded. There's a lot of concern about that, right? The bond market is not doing what we had in mind when we went into tariffs and things like that. Neither is the U.S. dollar, for that matter, and that is problematic for the Fed. It's problematic for our banking industry. But it's not just us, right? This is a problem that's kind of happening throughout the world. I mean, look at the Bank of Japan, for instance. I mean, they're in a big quagmire. And so the global economy seems to be at a big risk, in my opinion. And look, talk of tariffs and things like that, even though, we've cooled off the trade war with China for the moment. Again, Trump, talking about EU on Friday, heating things back up again. That's all really just, it makes you nervous, right? But not only that, consumer debt is a big question mark, and I think a big potential problem. And not necessarily for your more capitalized individuals, but people that are using that Klarna or whatever to buy Chipotle and finance it, right? There's a lot of defaulting happening there, and so I think, as we have done many times in history, and go back to the housing crisis in 2008, 2009, I think we've gotten a little bit out over our skis on lending and how risky banks or lending entities have gotten with some of these loans that they've been making. And if we're going to start seeing some major defaults on things like that, I mean, that has a trickle through effect at a very bad time for the banks that are already struggling with how 10 years and 30 years are moving, sort of in the opposite way that you would have thought, with pressure in the stock market, with a strong US dollar, or I'm sorry, with the dollar being under a lot of pressure when it probably should have been stronger. So yes, you've got a lot of very concerning economic things that are happening all kind of at the same time. um, it's a big concern. It's a really big concern. And what does that do? Can we see stagflation, right? And so, what would stagflation mean for commodities?
Yeah.
Well, the problem is that inflation kind of has waves, right? And the original wave of inflation, which is what we had in the beginning of COVID, when we started printing stimulus checks and just adding liquidity, or printing money, adding money into the economy. When you add, it's basic supply and demand. When you add more of something, it's intrinsically worth less, right? So when we put all that money into the market, commodities as a whole had to go higher. So that's your first level of inflation. Your second level of inflation is when products go higher because of the more expensive raw commodities or input costs, right? or even just the energy to make things or transport things. So product prices go higher. So we've seen that already. The third one is what happens with the labor force, because eventually people need more money in order to afford these higher priced products. And so we're in that sort of tertiary level of inflation. We've already seen, I think, the inflation in the raw commodities. I think if we are to get into a stagflation type situation and an overall negative, bad economy, globally, domestically, I think the effect that would have on demand for things like energy and things like feedstocks is a bigger negative effect than what the positive inflationary effect might be. Um, so the other thing is that the dollar's already had a big move to the downside
Yeah.
at a time where you could argue where we should be more leaning towards deflationary in the climate of tariffs. Again, that's been on again, off again, but if that dollar does start to gain strength because of an economic slowdown, that actually goes a long way to offsetting commodity inflation. So I don't know if stagflation or inflation in commodities is going to come to save the day. I think inflation happens in other places. I do think we spend more to get the same amount of something, but it's not necessarily coming from input costs. That's my problem with that.
What about on the livestock side and the meat sector? I mean, you think about the consumer, debt issues and more, and we've been
Yeah.
talking about this for a while. When is the consumer maybe going to start pushing back on high prices for beef, for instance? And I mean, there's a disconnect. I mean, between cattle futures and cash, for instance. I mean, things are still at such high levels here. And that's another aspect of this as well. I've been saying for a while that I have to think that cattle are going to find their top once the consumer starts to push back at the meat case, Ted.
Yeah. Right. And that's I mean that's really it. And it just hasn't happened yet. There's the American consumer seemingly has blinders on, and which I guess you can't really blame them. We've heard for years, going into COVID and then after stimulus with COVID about all the inflation and how the economy's headed for a train wreck. But it really hasn't happened. Yes, we've had our corrections, we've had our weeks or a few days at a time where, oh gosh, the sky's falling, but then very quickly we come right back. So I think the American consumer's gotten very jaded to all of the talking heads saying, "Oh my, there's cracks in the foundation. The economy's, we're set for this big break and things like that." The consumer says, "Yeah, yeah, yeah, whatever. I've heard that before. It hasn't happened. I'm still going to go spend money." So there has to be this event that really does have some staying power, that really does shake people out. I think the possibility of that is really high, but again, it hasn't really happened yet. So, yeah, for the moment, people are still spending money. You can see it in pork too. Pork cutouts are pretty hot too. I mean, and actually, I mean, Packers margins are still negative because, like you said, there is that big disconnect between cash and futures. And even though box beef prices are strong, cash cattle is just trading at astronomical levels. The Packers really cut back production, which you would think, over time that's going to increase the supply and basically fix the problem for them, anyways. But so far, that's not been the case. I really worry that we're at some prices that are just unsustainable. I mean, markets just don't go straight up or straight down forever. It does feel like cattle has just been going straight up forever. And again, it does not seem sustainable for me. So for a lot of reasons, I think there's good reasons to protect the downside. I don't know if you really want to be selling futures. I mean, that's a very scary proposition with the sort of volatility that we're having, and but I mean, owning some downside puts, things like that. I think it's really the climate where you want to be pretty proactive about something like that.
Very true. Very true. Ted, good stuff as always. Anything final you'd share or reiterate for folks here today?
Man, I don't know. We covered a lot of ground, Jesse. Like I said, I think next week's going to be a really big week for the grains. I think by the time we get to Friday of next week, we'll have a general feel of how the beginning half of the growing season is going to go. So do pay attention to that. And yeah, I mean, head on a swivel, man. I'm not exactly sure what the main focus of the market will be. I mean, it's generally weather, it's generally production, but again, there are bigger picture things that could certainly get in the way of that. So I just be nimble, right? I mean, be nimble. Don't sleep on a marketing plan. There are strategies that you can be using for a situation like this that are just perfect for a situation like this, actually. So work with a professional, or I mean, look, I know a lot of guys that are savvy enough to do it on their own, right? So yeah, my point is just don't be a spectator, right? Be aggressive, be aggressive. Like that's the type of year that we're in, right? I mean, there's other years where it's just like, it's probably not a whole lot of downside risk right now. Seasonality is good. I mean, maybe it's a great time to pump the brakes on aggressively marketing. Well, I don't know if that. I don't know. Maybe that is the case. Maybe that isn't the case, right? It's just there's too many unknowns right now.
Well, always remember that risk of trading futures and options can be substantial. And Ted, if folks want to work with you there at Zaner Ag Hedge, how can they get in touch?
Yeah, you can reach me directly, 312-277-0113. You can also visit our website, zaner.com. You can sign up for our afternoon commentary, which is me leaving a 5 to 7 minute message recapping the grain markets for the day. I do that pretty much daily. It's done by about 2:30 Central Time. And aside from that, I'm on the X platform, Twitter, whatever. I'm at the Ted Spread.
Ted Seifert, Zaner Ag Hedge. Always good to talk with you, buddy. Thanks for joining us on the show today, and we will talk to you again soon.
Thanks, Jesse. Thanks for having me. Love doing it, man. You have a great weekend.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.